Let's stick with the broader market this morning. Our next guest says that economic pain is likely in 24, but doesn't mean that stocks will struggle all year long. Charles Schwab, Chief Investment Strategist Ann Sonders joins us this morning with a playbook for next year. Ann, good morning. Great to see you.
Good morning, Carl. Nice to see you, too.
It sounds like one of the lessons you're trying to put forth is that sentiment swings both ways, and you kind of got to watch out for that chop.
Yeah, and investor sentiment has been such an odd duck over the past year or so, really mixed messages. One example is just recently, in conjunction with the rally, you saw attitudinal measures of sentiment like AAII bulls really spike higher, bearishness moved lower. But AAI also does a monthly allocation survey on what the actual exposure is, and that has come down. So it's sort of this dichotomy between what investors are saying, and they're often short-term reacting to whatever the market is doing, and what they're actually doing. But also in contrast to individuals lowering exposure, the average active manager has actually been increasing exposure. So you're also seeing that divergence there. So there are times where sentiment's really clear. This is not one of them.
Yeah, it kind of reminds me of what UMISH is saying versus what retail sales are saying. I mean, exactly. Active managers are consumers too.
Yeah, and I think, for active managers to be a little bit more enthusiastic is not terribly surprising, and very much in keeping with what Mike was chatting about before. You are seeing this rotation. You're seeing a broadening out without a sort of collective downturn in the market. The return of the risk-free rate more broadly means ostensibly a reconnection of fundamentals to prices. And I think that's providing a more level playing field for active managers relative to passive indexes. That was an on and off theme throughout 2023. I think it's going to be a big in 2024, where active managers actually see a sort of a growing roster of opportunities, particularly outside of the Magnificent Seven.
Is that still true, Ann, if the Fed does embark on an easing campaign? Because one of the key reasons behind this dispersion that we're seeing is because higher interest rates have kind of created this renewed attention to fundamentals, as you mentioned. So if that reverses, does active management still kind of play that same role in 2024?
Well, I think there's a lot of question marks short term. If you lay out everything that the market's been doing, the market has priced in probabilities for Fed policy in 2024. It's hard to square the circle because an environment in which the Fed actually does start cutting rates as early as maybe March of next year, I don't think the backdrop to that looks like it does now. With inflation having come down, but still well above the Fed's target, not a lot of weakness in the labor market or the economy, how that provides a green light for the Fed to cut. So I actually think more economic weakness near term is probably a better scenario for the equity market than weakness that gets pushed much further into the end of the year and comes because the Fed has to stay at least in pause mode. So again, I'm not sure all of the various sort of implications and stories and narratives and what's being priced in all fit in some easy story. I think something's probably got to give a little bit.